looking at all the data that we've been seeing, especially in the previous week, so a mixed bag. We've also got US earnings underway. US President Barack Obama, of course, imposing that key levy on banks to try and recoup some of the stimulus that it pumped into the US economy to get us out of this recession. Taking a look at the overall picture, Cobie, are you feeling confident that things are going to get better from here?
I mean, if you look at the information, it continues to be a mixed bag. It continues to be a mixed bag of information that either drives markets slightly up or slightly down. You know, and on a week-on-week basis, you either see the market dipping or you know, essentially increasing in value. But over the long term, you know, markets generally do increase in value. And I think what's important here to take into consideration is that people partake in markets. People that do partake in markets over long periods of time, you know, stand to make good money out of markets, especially when they buy at good valuations like we have at the moment in the market.
Cobie, when you look at some of the economic data, some of it is really pointing to the fact that things are going to remain under pressure, especially on the consumer front. Do you think that perhaps we haven't priced in too much of a recovery because at the end of the day, the earnings have to match up to, you know, the kind of run that we've seen on the equity front, and the markets can't, of course, expect earnings to catch up if the consumer is still under significant pressure? You
know, the strange thing about markets is markets are always forward-looking. So what markets do is markets try and price in what earnings are going to be doing in the next 12 months to 24 months. So it's not inconceivable for price to run ahead of earnings in the very short period of time. And that's what we're seeing, you know, right across the board, is that prices moved ahead of what earnings are. But earnings in 2009 was down by 30%. And the question is, as it bottoms out, it has to start increasing again, because that's what a market is. A market is in the back end of higher earnings. And it doesn't have to beat its long-term trend. It doesn't have to be higher than its last high point. It merely just has to be up in order to drive markets forward even more. And that's why I'm saying that as markets level out this year, and as earnings potentially just increase by 5 or 6% this year if we're lucky, you know, markets will go up another, on average, 15%, because it anticipates an even better situation for markets in the next 12 months. And that's why I'm saying people that look past the very low earnings that we have at the moment in the market, and they look past this situation, they say, well, it's too expensive. Now it's too expensive, I can't get in. We should have got involved in the market last year, March, where you were buying companies with ridiculous yields. And today, you're just owning the same companies, but you're up already 60%. So if the market dips by 10%, maybe you're only up by 50%, but that's still a massive margin that you're up. And that's just a room and opportunity to buy even more stock.
Going to the debt levels of each country, now we know that the US, as I said earlier, imposing this bailout tax, but even if we do recoup some of the money that we put into stimulate the economy, at the end of the day, all the big economies on a global level are still sitting with huge deficits. So the debt problem was there prior to even the big downturn, the global downturn. So Cobie, at the end of the day, it sounds like we're still seeing systemic issues that are emerging in the US and Europe, and the question is, can they actually bring down these deficits?
And you're probably going to see them for the next decade. You know, they're not going to go away quickly. These are issues that come to the foreground in the back end of a massive crisis, especially if you're going to do something like stimulate an economy and you're going to bail out an economy, which is really rooted in deep economic theory at the end of the day. It's not something that the Americans thought out in, you know, as a great fix to the situation in the short term. The question is, can they raise their profile from a GDP perspective and just from, you know, from a consumer perspective in order to raise enough taxes in order to start repaying this debt? And that's part and parcel of what Obama has been doing. And this, you know, this is an announcement last week where he was talking about saying that, look, we've paid all this money out and we've spent all this money, but I'm not going to go to the taxpayer. The taxpayer isn't going to pay for this long term. I'm going to recoup some of this from the banks. And there's going to be special levies and the likes, you know, in the banking sector. A whole bunch of people saying that, well, that's really unfair on the banks, but is it really? You know, because it's the banks at the end of the day that created the havoc that we're in at the moment. And in essence, what we're sitting with a situation where Obama's just saying, look, let's recoup some of this money from the banking industry. It is so profitable as it is in any case. Why not, you know, why not recoup some cash out of this?
JP Morgan and Citigroup both hitting on the earnings front, but missed on the revenue fronts. And investors are still looking for that key revenue growth. So two big banks already coming out with negative results. Do you think it's going to impact the sentiment towards our local banks?
No, I don't think so. I don't think so. I think South African banks have come through, the subprime crisis and the credit crisis, with flying colours. In the beginning of the crisis, we saw this flurry of money leaving South Africa because people were saying in the West, well, if it's this bad in the West, could you imagine how bad it could be, in emerging market space? And then they realised, well, it's actually not this bad in emerging market space. Maybe I should be buying these companies. And then you saw a market appraising on the back end of that. South African banks are healthy. There's nothing wrong with them in the way in which they in the way in which they operate, and generally they priced well. So when you get a buying opportunity, you buy those.
Looking at strategies for this year, a lot of investors that I've spoken to say it's all about stock picking rather than buying into specific indices. Do you agree with that?
Well, I tend to disagree with that because all stocks rise in a tide that comes in. So if you're going to have economic activity and it's going to flow through the system, you're in essence sitting in a situation where all stocks will rise on the back end of that. And yes, I mean, stock picking and stock selection makes up an important component of that. But the very big component is, should you be in stocks or shouldn't you be in stocks? And that's where, for most investors, I mean, we talk so much about stocks on this program, but I think many investors forget about a well-diversified portfolio. And I mean, a large portion of what the average investor should be doing out there is trying to diversify their risk across multiple asset classes and not just owning one asset class such as shares. There's things such as property, there's bonds, there's cash, there's a whole bunch of other stuff that you could potentially be looking at owning, in a market that is directional and will become more directional as time continues.